Hey guys, today I'm going to tell you guys exactly how a short squeeze works and show you how you can predict a short squeeze so that you can get in early on these AMC and GameStop type of stocks that way you make the most amount of money. And so let's get into it right now. Let's do it. So before we get into how the short squeeze works, you kind of have to understand how shorts themselves actually work, all right? Basically, the way that a short works is if a short seller, all right, thinks that a stock is overvalued, they'll borrow that stock from somebody that owns it on what's called a margin account. They have to sell the stock and hold on to the money as collateral inside that margin account. But eventually, they have to buy the shares back. Their thought and their hope is that the stock is overvalued. One, and we'll use GameStop for this example, right? The short sellers thought that GameStop stock was overvalued and it was likely to go out of business. So they shorted the stock. Let's say the stock was trading at $20 a share. They shorted it with the expectation that the stock would drop to $5 a share or even lower, or even claim bankruptcy. Okay. In that instance, they get to keep the difference if they have to return the shares. So let's say I borrow 100 shares from you at 20 bucks and the stock drops to $5. I buy 100 shares back at $5, give them to you. Hey, here's your 100 shares back. And I get to keep the $15 difference. And it also works in reverse. And this is where the short squeezes come in. This is where the stock goes up to $35. And now I get nervous that I don't have the money to pay you back. Okay. And that's when I go buying the shares. And then that happens at an exponential level. So if there's a large number of people that shorted the stock and the stock starts to rise, these people without the money to call them have to start buying the stock immediately. There's no limit on a short sale. There's no rule necessarily when the short seller has to pay the shares back. Usually it doesn't really get claimed back until the seller originally asks for them back. But that's as long as the person that has the short shares are paying the interest that they're supposed to pay because they basically rent the stocks from you. As long as they're paying that, then they're fine. So like if I'm paying you 5% interest on the shares and I see my shares are going up anyways, I mean, I'm loving life. I'm getting 5% interest from you for shorting my shares. And as long as you're paying that, all's well in the world, right? So if it gets too high though, if it gets too high of a gap and the broker that's holding the margin account thinks that you can't cover, basically means that you don't have the money to pay for that, then they can cut you, right? They can say, hey, you need to start paying some of this margin. You need to pay even more to cover these losses, right? This is where people have to start buying, and this increases this price. And then as the price goes up, then the other margin call people say you have to start buying, and this is where problems happen. This is where the losses that you're seeing on these massive hedge funds are coming from. So they were way over leveraged and way over shorted, right? So that does that. Sorry, I have allergies, so if I have to breathe in deep sometimes, it happens. I apologize for that. But next, what you need to know now is how to predict the short sale. So now you know how the short sale works, and that's why the prices continue to rise, and they can really go up exponentially as large as they want. That's why people call for 1,000 GameStop. They call for $200 AMC, because literally as these companies start to have to call their margin, they get higher and higher, and they start losing more and more money the higher the price goes. So they just start buying in a frenzy to try and buy it before other hedge fund guy buys it and stuff like that. So it can create an exponential surge and pop. And that's what you're really banking on in these short squeezes, right? So maybe you don't own AMC, maybe you don't own GameStop, maybe they're too expensive for you right now, or maybe you think you got in too late, too early, whatever it may be. This is a way you can predict, we'll get into that now, how short squeezes could occur and the potential of these companies to be short squeezed, right? And it does take an army like you guys have on Wall Street Bets there. It does take a group of people holding on to those stocks and not selling them at all, right? So this is where you're really going to get that. But this is how you look out for it. And these are where opportunities lie. So you can get your little army together and you can YOLO, diamond hands into these things. So this is what you were looking for, okay? You need to look at the short interest percentage, okay? And that's going to be basically simple math. It's the number of shares shorted divided by the number of shares outstanding. So in a simple example, if I have 100 shares of a stock outstanding, meaning the total amount of shares that are in existence for that company, 100 of them, and 10 of them are short, it's 10%. If 20 of them are short out of the 100, it's 20%. The higher percentage, the more likely you get the opportunity to short squeeze these. All right. So the other factor that actually has to make play is going to be your short interest ratio. All right. Basically, what that is how many shares trade per day. So the average daily volume divided by how many shares are short. Okay. Because that's going to basically tell you how many days of buying it would take for these guys to cover their short positions if this stock starts rising. And that's where the panic sets in. That's where these companies and these hedge fund guys get super scared and nervous, okay? Is when that gets larger, okay? So anything over 5 days is really good because it's gonna take a whole week of trading if you bought every share that normally trades, it's gonna take the whole week of trading just to buy your shorts back, right? So for example, let's say there's 200,000 shares that are short in a company, and the average trading volume is 50,000 shares per day. Okay, that means it would take you 4 days, 200,000 divided by 50,000, take 4 days of buying every share that's traded to cover your shorts. And this is where the squeeze occurs. It's those two factors, high short interest, right? So high short interest percentage. So let's say 30, 40, 50% of the shares of the entire company are short. So what that means is there's only a few shares left that are actually trading. There's a smaller amount. And in the case of GameStop, I believe it was back in January or December, it was closer to 100 and even over 100% of shares shorted, which is astronomically high and ridiculous that they would even allow that, and that's even legal. But that's a video for another day. And then what you're looking at is how many days it would take to cover those shorts, and that's what you're really looking for. I have a few stocks out there that I believe I'm looking at that have potential to be high in those categories, but that's what you're really looking at. You guys want to run your stock screeners on those things, and then and that's how you factor it in. That's how you predict the next short squeeze, and that's how you get in early on it, and that's how you take advantage of these people that are shorting these stocks, that are shorting way too many stocks, and there's not enough shares traded daily to cover those stocks, and even in some cases, 2 weeks of buying every share that's traded on average, it will be what takes these prices to the moon, to basically infinite levels. And as hedge fund managers have to cover these losses, and they have massive drops in their shares. I mean, in their loss column, people start pulling their money out of there. Big time investors. I'm getting my money out of this guy. This guy's screwing everything up. His returns are negative 10% when the market's booming in a bull market, and that causes hedge funds to go out of business. That really destroys it. And that's when Robinhood jumps in and tries to, oh, we're gonna save the hedge fund guys by not letting you guys buy anymore. And that's when the politics get into play, right? But with that, guys, that's just a way to predict it. That's a way and how short squeezes actually work. If you guys want, I can make another video on stocks that I have on my radar that are short and that are possible short squeeze opportunities. If you didn't get into AMC or GameStop, if you're in those right now and you're holding out for the short squeeze, you want to hold out for the short squeeze. Okay, you don't want to sell those right now. You want to wait it out. It's not financial advice. I'm not allowed to give that. But if you're really holding off on that, the longer you're holding on to these things while the short squeeze is actually occurring, and these guys have to buy back those shares, you guys will be all right. But you don't want to sell those necessarily just to jump into these stocks that I have on my radar. That would not be beneficial to the squeeze itself if you're already in GameStop and AMC. But if you're not in those, these are potential opportunities I can put down there for you guys and make a separate video about them if you'd like. And I can kind of give you my thoughts on how I came up with them, how I went through this process and figured it out. So with that, guys, I really hope you enjoyed the video. Really hope you like it. Subscribe, share, whatever you guys like to do. Don't dislike it. I don't know why people would do that, but okay, whatever. Just dislike it if you want. I don't care. But I appreciate it, guys. With that, y'all have a wonderful day. Hope y'all make some money, make some bank, get after it.